All right. Well, I am thrilled to welcome Nandini Mansinghka from Mumbai Angels Network, which has been a very early entrant into the Indian in entrepreneurship financing ecosystem, a big influencer and a big, high impact player in the Indian ecosystem. Nandini, welcome. It's great to have you. I'm thrilled to catch up after so many years. Nandini and I last actually saw each other in person back in 2011 when I was doing a workshop in Mumbai, sorry.
Yeah. Been a very long time.
All right, well, Nandini, I will let you introduce yourself and the work of Mumbai Angels Network as a starter, and then we'll dive into the details.
Yeah, sure. So I'm the CEO and Managing Director of Mumbai Angels. And Mumbai Angels is one of the first angel networks in the country. We started way back in 2006. So, we've now been 12 years into the ecosystem, and we started out at the time when angel investing itself was not very well understood in the country. From there, today we have, a large network of 350 members. This is across 7 chapters. So, we are one of the premier, pan-Indian network in the country. So we are in Mumbai, Delhi, Bangalore, Goa, Calcutta, Pune, Hyderabad. So 7 chapters, 350 members. We now have a portfolio of about 130 companies, and these are all at the angel stage. So we invest anywhere between $20,000 to $30,000 to up to $200,000 in each startup. And we take it through, so we do not just the initial round, but several of our companies also do the bridge round. So these are all pre-Series A investments. What we started doing, and this is what our core of who we are has been, and it's just recently that, we've actually ventured into 3 other verticals. And the first one is what is called the growth capital network. So we realized that, there was this gap between the angel funding and when companies were actually being funded by, at say, Series A and beyond. And what was happening is that because those ticket sizes might not be big enough, you were not finding platforms where these companies could talk to the VCs and family offices. So that's the gap that we are now also filling in. So now we look at companies. So there is this platform, which is the angel platform, and then there is this Series A platform, if you might, as a nomenclature, where we look at funding anywhere between $500,000 to a couple of $1 million. And there the investor base is more on family offices and smaller VC funds. So those are the 2 things that we're doing. The third thing that we've recently launched about 5 months back is an Angel Academy, because what we realize is that, as whenever somebody is coming into the angel investing ecosystem, irrespective of their ability to invest, a lot of people would not be able to invest because they don't understand the asset class. They don't understand how to actually go about investing into a startup. So we have started taking those sessions. So, if you look at what you are doing, Shramana, we're actually trying to do the other side of it. So saying you actually start building.
Very necessary.
So that's what we're doing. And we're also doing one very large event in Mumbai on the 27th of February, which is called Beyond. And this is again focused on companies that are raising anywhere, from their Series A and up. So that's again a day-long session where we will get investors in, startups in, and just try and build that melting pot of ideas and interactions. So this is who we are.
So, Nandini, can you talk a bit about the way you work? Like, an entrepreneur wants to work with Mumbai Angels. What would be the procedure, and is it a subset of the angels who are investing, and how do you manage that process? Just give us a little bit of color on the mechanics.
Yeah. So, we receive about 5,000 applications for funding every year, anywhere between 4.5 to 5,000. And these come through several different channels, right? One of our strongest ones are recommendations. So recommendations by members, recommendations by companies that have got funded earlier, and our ecosystem. So that's one. A lot of startups are applying directly. So pitch at mumbai.angels.com is the email where people can write and send us their decks and stuff. And then of course there is the outreach that we are doing continuously on saying we are there at events, we are there at different forums and trying to understand. We work a lot with accelerators and incubators to try and see that their companies can we look at. So those are the 7-8 types of cases where we look at. Once the company applies to us, or once we get in touch with them, we ask for their deck. That's our the starting point. Saying, okay, here is the deck. Tell us, and we have the standard format, which is, it's called the BCA. It's called the business case analysis. So we would want to understand from the startup as to, what is the problem that they're solving? Why do they think, they are unique? Why should we bet on them as a company in that space? And this is done by our internal investment team. So once you clear through that level, we put up the shortlisted companies out on the platform. So right now we're using Cust as a platform, where we put up these shortlisted companies for our investors to look at. So this is a very focused place where we then start evaluating, saying which startup is getting enough interest from our and we look at these members as early adopters. So what's happening is that while you open this up to all 350 members, not everybody is very active online. There would be some, so maybe about 20 to 30% of our member base is going through those pitches. And then based on their interest, we again shortlist to come to our final shortlist. So in any given cycle, our shortlisting is actually anywhere between 1.5 to 2% of the companies that have applied. So what I mean by that is on an annual number, of the 5,000 companies that apply for funding, we look at anywhere between 50 to 70 of them for our members. And once you are shortlisted over there, you would, and then we have these showcases across all our 7 chapters. So these are physical meetups that happen, and you will have anywhere between 20 to 50 to 70 people in the room. These are investors plus guests who've come who are looking to become members with us. And then every company gets to pitch. So it's a half an hour pitch. These are physical pitches that you're making, which is where you're pitching for 15 minutes, and then there is a Q&A, so half an hour, and then there is the networking lunch or dinner that happens where you can interact with the members. So that's where and each company could be showcasing anywhere between 3 to 4 of our chapters, and of course they are open for investment across all. So physically you would go to about 3 or 4, but you would be open for investment across all 7 chapters. And then we start looking at the investor interest level. Depending on the investor interest level is when we start doing the due diligence, the one-to-one calls, and we start moving through the process. And then the book closes or the investment closes when the amount that is asked for is covered by one investor. So typically in each investment we see anywhere between 5 to 15 investors coming in, and each one would be cutting a check of anywhere between $10,000 to $25,000-$30,000.
Okay. And what about sectors? Of course, India has gone through a lot of different cycles already in terms of sector popularity and experiments and so forth. So what are your conclusions, investment thesis around sectors at this point?
That's a very interesting question, and we've also actually we've seen a slight shift in trend over years. So if you look at our portfolio of 130 companies, initially, we were focusing a lot on tech and tech product companies, because I think there was this whole, the hypothesis was that, we need to look at startups in a similar way as the Valley. But over the last 3-4 years, we are seeing a distinct change in how these are being looked at. And there are some sectors that we see gaining a lot more traction at the Angel network level, and specifically in our level. One is, what you call the India consumer story. So any company that is trying to address the need of the urban Indian, trying to solve issues, and this could be food companies, these are, just food apps, actually, like for example, right now we've actually invested in a tea company, we've invested in a parfait company, we've invested in a chip and dip company. So India consumer story is a big one that we started seeing as a trend. We've also seen a lot of interest in what you can classify as healthcare and life sciences. So health tech, med tech, that's another one that's coming up. And when we say health tech and med tech, we're talking of companies that are solving, problems for the Indian consumer. So, how to make healthcare accessible to the common Indian. So, for example, we've just invested in a company where they actually detect if you have TB or not, tuberculosis or not, just by coughing into the mobile phone. So just by the sound of the cough, you can actually, So, and you're using it at a fraction of a cost of what an otherwise detection of, something like this would be. And we're seeing several such companies coming to us. So that's the other big segment that we see. And then, of course, there are these, what you would classify as tech. So tech is a big part of our portfolio anyway. So, for example, we have a drone company, that's looking at solar panels across the thing. We have a battery company that is that can recharge a mobile phone battery at a fraction of a cost and a time than any other conventional thing. So those are the other bits that we see. So these are the 3 buckets that we're seeing gaining a lot of traction. Apart from that, we are sector.
Within tech, what is your analysis of the software as a service market? Of course, India has gone very big into software as a service. The VCs have gone big into it, and it kind of plays naturally to India's strength because of such a large software programmer population, and many of them have turned into entrepreneurs, and SaaS is the easiest thing for them to do because they can code and they can acquire a few customers and get moving. So what is your analysis of that segment?
So, from our perspective, we haven't seen too many deals happen in that segment. So it could be because, I think it could be a problem of plenty. That, it might be easier to start a service like that, but you're not being able to actually demonstrate how are you different or how you're actually solving a real problem. That's one of the situations that we see. The other thing is that these companies require a much larger amount of funding than what we are looking at the angel stage. So we haven't seen too many companies come in as software as a service in the recent past, and we haven't really seen too many of them gain traction. So even if you're getting that pie, we haven't seen too many. Having said that, I think at any given point of time, there are at least, of our entire pipe that we have at any given point of time, there are at least, I would say, 50% of companies that are pitching to us in different forms of SaaS and different kind of platform services. It's just that recently we haven't closed any such deals.
Okay. And you mentioned traction. So for Mumbai Angels to be interested in a company, what kind of traction do you want to see? You don't do concept financing, it sounds like.
We would do concept financing so we won't fund anything which is a paper company. So it's not an idea stage that we are looking at for sure. We would require revenue traction in all cases except for two cases, right? One is where it's a tech product. Then if it's an IP build out, we are okay to say, okay, we'll fund you because we want to work with you through the IP build out journey. And a similar such investment we do whenever you're looking at a healthcare product. Like for example, again you're waiting for the licenses to come in or clinical trials to come in, look at, molecule, and to look at that. So those are the two situations where, like for example, right now we've just invested in a liquid biopsy company, which is finding a newer way to detect cancer through blood samples. So we've invested in that company when it's a preclinical trial stage, and we have funded them to take them through the clinical trial. So these are the two situations or two instances where we would not look for revenue traction, but for all other instances we will look for revenue traction. And when I'm saying revenue traction, even if the revenue traction needs to be higher if it's a B2C concept or if it's a marketplace concept, and if it's a B2B, then you just need to get one or two beta customers who have gone along the journey.
Now, as part of your Indian consumer story, what is your position on entertainment? So there is a lot going on in digital entertainment in India. We have companies in our portfolio that are very excited about this digital entertainment opportunity. They have millions of users. So what is your position on that?
Yeah. So I actually have founded and started a company in the entertainment space. So I'm the founder investor of a company which is a B2B content market, so for finished for video. So I see clearly there is a lot of investor interest now in this space. What I have seen is that, for a sector agnostic investor and more importantly individual investor to understand the media and entertainment space, it's a pretty tough ask. Because what happens is that most of the time we find, so as Mumbai Angels, we find that when we bring companies in and who are talking of, advertising-based revenues, they're talking of building IPs, they're talking of influencers, the business model, if you are not a media entertainment investor, you will struggle with it a lot. That's number one. And B, we find a gap between the valuation, the ask from the founder and what the investor is willing to pay for. And we see that gap to be much, much larger in media and entertainment.
I see. So you don't, being in Mumbai, I would think that you would have media and entertainment angels. Is that not the case?
So see, the investors who are putting money in entertainment and media are a different, I would say a different makeup than people who are actually as angel investors through the regular route. So, for example, you don't really have a media entertainment angel network in Mumbai. So, and people are doing the investments, but like for example, like me, when I started this up, or when I'm investing in media entertainment startup, that's a very different set of people. These are people who are from the industry and who are now saying that what else can be done? Because I think it's a very tough segment to understand actually.
It is actually, and especially if you're experimenting with business models that not straightforward advertising, like straightforward eyeball monetization. If you're looking at other business models like we are, because I'm actually not a huge believer in straightforward eyeball advertising as a great monetization technique. So with our companies, pushing on other more creative business models. And that's, yes, you're right. It's harder to understand and harder to get your arms around. So switching gears a bit, what is your perspective about this whole unicorn phenomenon? Everybody chasing unicorns and billion-dollar market opportunities and, billion-dollar valuations. Is Mumbai Angels chasing unicorns?
No, we're not. Look, I think for us, it's a mix. Look, we've had unicorns in our portfolio. So InMobi was one of our first successes.
Yeah.
We've had others too. We've had several others, who built it to a certain level. And who have, been bought out by much larger players. So we've had some of our companies being bought over by Twitter, Paytm, those things have happened. But see, our view is that unicorn chasing is, I think it's counterintuitive, really. You can actually get caught up in this so much that you actually stop looking at investments that can actually build you a healthy portfolio. So we are of the view saying that, you will have to do this continuously. So as an investor, you have to do this continuously. You have to decide saying that, look, here is what I'm looking to invest in startups, and then do that over and over again over several years. Unicorn chasing, I think, can be done only if you are a seasoned full-time investor, and you are out there, and you're a fund, and you're saying, look, I'm willing to support a company through its process, irrespective of the money it takes.
Yeah.
I don't think all businesses are built like that. That's number one. Secondly, I think a lot of times when we try and push companies to become unicorns, or even if you're not saying unicorns, if you're just saying, the scalability question, if you actually push them beyond what their business model actually can absorb, you will actually have a company that's trying to grow much faster and burn much more without really knowing why they're doing it.
Yeah.
So we see that happen over and over again with our portfolio companies. So,
and that is a surefire way for angel investors to lose a lot of money, because angel investors can't really continue to invest, over and over again. They can't invest tens of millions of dollars to stay in the game and maintain their shares. So if they're getting diluted in this, unicorn chasing game, I think it's a very dangerous way to play this market for angel investors.
So I think what will happen is that even in our portfolio, we do come across, once in a while, we come across a company that looks like a potential unicorn. And that's when you will finally see a lot of investors coming in, I would say.
Yeah.
But over a period of time, we haven't always seen that cases play out. So the ones that you actually think are potential unicorns are also the ones that run out of money fastest. Because you said, okay, here is money for 18 months, and then you suddenly realize, oh, it's 12 months and the money is run out. And because you've not really built a steady revenue over that time, or haven't built your product by then, the next round of money is not coming in. So like you said, it's I would be careful on, if you ask me, between scalability and sustainability, I think I am more on the sustainability side of it. But yeah.
So we're on the same page. And as you know, I'm not popular with a lot of the VCs in India for saying what I say. They're pissed off with me because I've been harping on this topic for many years now, and I have a big voice, huge influence. So they don't like the fact that I keep harping on this. So
I think it's yeah.
I was going to say that, did you read this article that I recently wrote, Bootstrapping to Exit?
No, I haven't, but I will.
You may want to take a look at that. I actually think that more micro VCs and angels and angel networks should consider the bootstrapping to exit strategy. And I'm doing a big kind of expose on that right now to look at what's happening in the industry. And if you look at many of the companies that are playing this space, for example, Freshdesk is now Freshworks. This is a company that we incubated many, many years ago and is one of India's big success stories. They've made 9 acquisitions, and most of them are either bootstrap startups or very modestly capitalized startups, because Freshdesk is just reaching about 100 million ARR, and they have reached the unicorn valuation, so the money is pouring in from investors. They have the capital and the equity currency to be able to do these smaller acquisitions, but they can't go and acquire another $100 million company. What they can acquire are companies for $5, $10, $15, $20 million, and that would, so they have strung together 9 acquisitions to expand their product roadmap, bring new capabilities into their platform. So, and this is happening across the board. I see Zomato is doing that, and in the international arena, if you follow companies like Atlassian, Smartsheet, Qualys is doing this in India in cybersecurity. There are a lot of companies that are following this strategy on the buy side of acquiring smaller companies that are modestly capitalized or bootstrapped. They can't afford to buy heavily venture-funded companies because the valuations expectations are too high, but they are acquiring companies that are reasonable, and that could give investors great returns.
Yeah, we see it in our portfolio increasingly more nowadays, So what you're saying is playing out in our portfolio too. So, for example, our portfolio today is so if you look at it as an index fund, so if somebody invested in each and every company that Mumbai Angels has been with, so today we are at a IRR of about 31%. Which is much better than, whatever most other funds would be out there. And we are not picking and choosing, right? We are out there saying, listen, here is a platform. We will look at companies that are coming. We will invest, and we will ensure that, they're taken care of as a portfolio and positive exits through and through. So completely agree to what you're saying that, I don't think the idea is to keep chasing the unicorns, keep pumping in money. I think companies can be built in frugal, with a lot of discipline.
Capital efficient. And focus on sustainability, focus on customers' revenues and profits to become sustainable, and then finding a reasonable exit that gives everybody good returns.
And most importantly, don't run out of money till the next round comes in.
Running out of money is death. You can't die and be successful. You have to survive to be successful. All right. Well, Nandini, that was great catching up with you, and let's keep in touch and maybe do some stuff together, actually.
Absolutely. Thank you. It was great being here.
Coming.
And, so like I said, if there are people who are listening, and if you think that there are companies who would like to raise money from us, they can write to pitch@mumbyangels.com. We would be very happy to look at the pitch.